Hey guys, if you're trading the US stock market or crypto, you've probably seen these colorful patterns: hammer, shooting star, doji. But here's the million-dollar question. Do they actually work? The truth is, most beginner traders lose money because they trade these patterns like a robot. In this video, I'm going to show you exactly when these patterns are gold mines and when they are just traps. Let's dive in. The biggest mistake? Trading a pattern in the middle of nowhere. Imagine you see a bullish hammer. If it forms in a sideways market or a random spot, it's probably noise. Candlesticks are not signals by themselves. They're just price action clues. Think of it like this. A hammer is just a sentence. To understand its meaning, you need the whole paragraph, which is the market context. So, when should you actually hit that buy or sell button? Look for these three things. Point 1. Location. Only trade a bullish pattern at a strong support level or a bearish pattern at resistance. Point 2. The trend. Don't fight the big players. If the trend is up, look for bullish patterns on the pullbacks. Point 3. Volume check. If a pattern forms with high volume, it means the big boys, institutions, are involved. That's your green light. When not to trade. Now let's talk about when to stay away. During high-impact news, like Fed meetings or CPI data, patterns break like glass during volatility. Choppy markets. If the price is moving sideways in a tight range, ignore the patterns. Chasing the move. If the candle is too big, your stop loss will be huge. Risk to reward is king. Don't ignore it. Bottom line, candlesticks are powerful, but only when used with a strategy. Stop looking for patterns and start looking for areas of value. If you really want to learn trading and change your future, then watch my upcoming 6 videos. I guarantee you that your perspective on the market will change. Subscribe to see our new videos, and remember, mindset is everything.